right, welcome back from the break, and our guests this week, Jimmy Vreeland and Bob Scott, both co-owners of Joint Ops Properties. They are real estate investors in the St. Louis area, former U.S. military officers, and both of them, Jimmy, a graduate of the United States Military Academy in 2003, and Bob, a graduate of the United States Air Force Academy in 2006. Gentlemen, thanks for coming on Kennedy Financial.
Thanks for having us. Glad to be here.
Well, of course, we got to know each other through none other than the Tom Woods Show, so we just want to thank Tom right off the top. You guys happened to catch my interview with Tom there, which was a life-altering experience for me. You know, it's not every day you get to interview one of your heroes, and now it's continuing to pay great dividends because I'm getting to talk to guys like yourself. Jimmy, you reached out and you said, hey, is your audience interested in something called infinite banking? And as I mentioned to you in the pre-interview, Jason and Mo from Wall Street for Main Street were kind enough to meet us for dinner one night. And Jason, you know, he's a really intelligent guy, very talkative, and he started getting into something called infinite banking and the infinite banking concept, or IBC for short. And he's a really bright guy, and he was talking really fast, and most of it was over my head. So when you offered Jimmy to come on the show and talk about the IBC, I was excited. I'm glad to take you up on it. So please, take your time. Explain to us what the infinite banking concept is.
Okay, the infinite banking concept is basically using life insurance policies instead of commercial banks to store your dollars. And so, in my contention, and I'm sure a lot of Tom Wood's audience contention, is that banks aren't really banks anymore. Like when I say that, is that you agree or disagree?
Myself? No. Yeah, I agree. I mean, not compared to what our grandparents thought a bank was. That's for sure.
Right. If we went back to Caruso economics or Austrian economics, a bank would be a place where you store your dollars. And in the Middle Ages, it was a place, you couldn't go trade spices in India and carry gold all the way across the country, right? Or all the way across the continent. So you would need some place to store your gold and trade notes.
Right.
So generally a bank is someplace you can store your money, still have liquidity, but you can also at a minimum beat inflation by storing it there, right?
Right. That's the hope.
And can you do that today?
No. And that's why, folks are not able to retire with dignity. They save all their life if they were strict, and then, they're hardly keeping up with inflation. And especially now with the Fed having interest rates locked at 0%, people are taking speculative risks, and they're not living out the golden years the way they hope to.
Right. So at a bare minimum in your finances, you got to find a place to store dollars that at a minimum beats inflation.
Right.
So there's only one place in the economy right now where you're not taking any speculative risk, and you can do that. And that is a whole life insurance policy.
Okay, so, a lot of folks have probably heard of Dave Ramsey, right? And he espouses term life insurance. And he's one of these characters out there who is adamantly opposed to folks purchasing whole life insurance. The recommendation is, look, you buy term life insurance, you take whatever the balance would be, and then you invest that properly, and that's how you create a nest egg. But then, there's other guys we believe in, like Jerry Robinson, the author of Bankruptcy of Our Nation, who says, look, these Fed governors, CEOs of Fortune 500 organizations, they don't buy term life insurance. They want to purchase an investment vehicle. They don't want to just put money into something for 20, 25 years and then get nothing when not have their beneficiaries get anything when they're deceased. So, I'm sure you're very familiar with both sides of that argument. Explain it further, and then explain why Dave Ramsey is wrong and why the whole life insurance product is not what he says it is.
So he's making one claim. He's like, just do it because it's cheaper, right?
Right.
So, I mean, what's cheaper, renting a house or owning a house?
It depends.
No, monthly. Out of your monthly expense column, what is cheaper, renting or buying a house?
Well, I still have to say it would depend. It depends on the size of the house. If there's problems with a particular house. You have maintenance and repairs and things like that. But if you don't own it, you call the landlord. So I guess it comes down to what does that particular individual want?
Well, so like, my house is worth I had to spend $200,000 to buy my house, right?
Right.
I could rent it. I could probably rent it for $1,200 a month.
Okay.
So when you have term insurance, you're renting the insurance. You're not buying an asset.
Right.
A whole life policy is an actual asset. On your balance sheet, it is listed as an asset, just like any piece of real estate or a small business or anything of that nature.
Okay.
When it's a term policy, it's an actual liability. All you're doing is renting.
That's right. That's a good comparison.
And where it's really dangerous is buying term when you're, when you're 20 to 40, the life insurance company's not taking on a huge liability. There's a great chance you're going to live, right?
Right.
Where it gets really scary is when you're, over 50. And at that point, to insure yourself gets really, really expensive.
And if you develop some type of health issue down the line, it can almost become impossible to insure yourself.
Where if you start a whole life policy at 20, it may be more expensive up front, just like buying your house at 20 might be more expensive. But it's an asset, and you are insurable for the rest of your life because of it.
And I think the other key thing here, which has like been a huge paradigm shift for us, is that you're not necessarily looking at the whole life policies just for the insurance policy. When Dave Ramsey talks about insurance, he's just looking at it from, if I die, can I cover my assets and provide for my family after that scenario? We're talking about using life insurance as an investment vehicle. And it's a place to store your capital outside of the fractional reserve banking system, and then use it as a place where you're still liquid and you can strategically deploy that capital when the time is right to strike on another opportunity as it appears.
So if the whole life policy is an investment vehicle, kind of explain what that looks like. Is it almost like it's invested in mutual funds within that policy? And is that how it's growing? How does it continue to appreciate? And how does that compare with, say, if you just bought $1 million 20-year term policy and then you took the remaining cost difference and then invested it in, say, ETFs, gold, the S&P 500, things like that?
I mean, what's the S&P getting for you right now?
Yeah, well, not very much. I mean, it depends, I guess, just like my rent versus own question. If you bought when it was low and now it's up around almost 19,000, or the Dow's 19,000, the S&P over 2,100, then maybe you did well. But for most folks over a career, it hasn't done so well. So,
right.
Yeah.
We invest in real estate. We don't invest in qualified funds, and we definitely don't invest in mutual funds because all the risk is put on the middle class investor for a measly 3 or 4% return. Would you agree with that statement?
No, yeah, you're right. I mean, that's why there's a lot of unscrupulous folks out there who've made a ton of money off the backs of the middle class, and then you get towards retirement age and you see your nest egg cut in half or even worse. But
right.
All those years,
it's such a fragile position. You're putting and our contention is that when you invest in a mutual fund or you invest in a qualified plan, you're not investing, you're speculating. The only way you can make money is if that stock or that index or that ETF goes up. True investing is you have an asset that can make money in a couple different directions. And really, our contention is that you invest for cash flow. That's why we like real estate, and that's why we like life insurance. So with going back to the life insurance policy, over the past 100 years, they've been returning people 4 to 5% returns every year. And that is without taking any risk in the stock market, which to me is huge. I will take a 4% return for a very small risk. In 2008, the cash value of everyone's life insurance, guess how much it dropped?
Tell me.
0.
Very
These
good.
survived the Great Depression. These policies survived the tech boom. And going back to what we said earlier, it's a place to store your capital, keep your powder dry, and still get a return, which is technically in a free market what a bank would do.
Yeah, and life insurance companies, if you think about like the concept of what they're trying to do, they're insuring someone's life for the next 50, 70, 100 years, and so they think very long term. And as Jimmy mentioned, these companies have been around for 100, 150, 200 years, and they survive the ups and downs. And because of just the nature of their business, they take that long view of the world, of economics, and they have to be very, very conservative with where they place their money. They're not chasing, short term.
They don't have to answer to Wall Street every quarter. They don't have to kill the golden goose so they can keep Wall Street happy every quarter. Yeah. None of these are publicly traded companies.
So you say they're making 3 to 4% per year. And
correct.
That I think that's fair on a risk basis.
We forgot to mention our favorite part about it. That is tax free, and it compounds tax free. Whereas whatever you're doing in the stock market is taxed in a big way.
Right. So I think we would all agree, or maybe not, but I'll just put it out there. I think inflation is much higher than what Janet Yellen says it is.
No one from the government would ever lie to us, Phil.
The most dangerous words in the English language, right? I'm from the government and I'm here to help you. But yeah, I mean, just looking at, say, a pound of bacon, in the, say, 15 years of the war on terror, a pound of bacon has at least doubled. But if your insurance policy is only earning 3 to 4% per year, then it's probably not keeping up with a pound of bacon. It's going to need to do better than that. So
here's the fun part about the whole life is the cash value in the policy is liquid. So you can go invest it any place you want. You could go invest in the S&P and get another 2 to 3%. Like me and Bob, when we invest in real estate, we get about a 12% return. So we put our money into a policy first, and then we go put it into a house, and it's earning money in both places.
So what if somebody isn't? And by the way, these are all devil's advocate questions. I like you guys. I'm reading your work. I watched your videos, and I appreciate you coming on the show. So please don't be insulted by any of my questions. These are just I know we're going to get comments later, and that's when the real confrontation begins. So I owe it to my listeners to be upfront. What if somebody's not a real savvy real estate investor, or they don't want to be like Robert Kiyosaki. They want to be more like Warren Buffett, who has only owned one house his whole life, and it's the same one he's lived in since 1953 or whatever. What does someone like that do?
Warren Buffett is a phenomenal speculator, and that is not. I can't do it. I think that's probably.
I mean, that skill set is one in a billion probably.
Yeah, I think the greatest myth is that. I love real estate because it's a low barrier to entry. I don't think anybody can just read books and become a great speculator, especially not after you read like Flash Boys and understand how much is dependent on the bandwidth of how you place your trade.
No, you're absolutely right about that. So, suppose somebody is fearful of real estate.
Say that again?
Well, suppose someone is fearful of real estate. Maybe they've read a book like Rich Dad, Poor Dad, or they've listened to Robert Kiyosaki espouse all the benefits of owning real estate, and that's how you build wealth. But, they don't want to be hands-on. They don't want the calls at, midnight, hey, a pipe broke and things like that.
Right.
How do you encourage somebody to then become a landlord and build wealth that way if they're fearful from the start?
Don't be a landlord. Just be a private lender.
Yeah, and private lending, for those that don't know, is basically loaning money to a real estate investor, a real estate entrepreneur, somebody who is experienced in the business, and getting a first position note and a deed of trust against the property. So you're basically acting like the bank in this scenario. And by partnering up with somebody who is really experienced, you gain the value of all that knowledge, and you can earn the real estate-like returns without actually having to deal with the tenants and all the back-end headaches and the day-to-day management that normally comes with, being a landlord and actually owning the piece of real estate.
So at the end of the day, that lender has a right to the property. They're just like the bank. And if the real estate investor cannot fulfill the terms of the agreement, they at a minimum still foreclose and own the house. Whereas if you invest in the S&P and they can't provide you a return, you're square out of luck. All you can do is sell at a loss.
And all you got is paper in the end. But in real estate, you at least have the asset.
A brick and mortar.
I see. Okay. So naturally, for guys like myself who talk about it all the time, the housing bubble is something that is not a distant memory. We think about it all the time. One of the reasons.
We think about it every hour.
Yeah. So yeah, tell me more about that, because interest rates are at historical, some would argue 3,000-year all-time lows. I'm an Austrian, so I believe that we've created a massive financial bubble thanks to artificially low interest rates created by the Federal Reserve that have now caused people to go and speculate on projects that have no merit. If I wish you guys were here in the DC area, I could take you around. I mean, some of these things they're building, we have no business building. I mean, we're building a metro all the way out to Loudoun County. There's a thing called Top Golf where they've got like these GPS golf balls.
Like, look at the pyramids. You can build great things if you're able to steal from people.
Well, that's what I'm getting at. That's what I'm getting at is, we've taken on a lot of debt and we haven't put it into necessarily productive things. So how, what is your feeling on everything I just said with regard to the housing market, and how would that affect someone who is positioned with the infinite banking concept?
Yeah, if you actually look back to 2008 and the real estate bubble and the people who really got themselves into trouble, they were speculators, and they were buying a house, let's say at $200,000 in Florida or California, New York, wherever, and they were expecting that in 2 to 3 months' time that same property was going to be worth $210,000, $220,000, whatever it may be. Right? They were riding the wave, and their only way to make money was the future appreciation of that property. And the way we operate is completely different. And we look at, when we analyze a property, it's from a cash flow perspective. So we never make any investment based upon, hey, what is this property going to be worth tomorrow, in 6 months, 2 years, 10 years? We don't care. And if it happens to us, it's a cherry on top. But our model is basically, can we, whatever we spend on the house, when we get a return on investment that is, above market, beating inflation, based upon what the property rents for. So I'll just give you an average scenario. Most of the properties we're picking up in St. Louis, we can buy a 3-bedroom, 1-bath ranch house with about 1,200 square feet for right around $45,000. And I'm sure that probably sounds crazy to you, probably sounds crazy to a lot of your investors, but that is the reality in the Midwest and a lot of like the Rust Belt states. You can pick up properties all day long for those type of price points. And that same property we're buying for $45,000, we can then go turn around and tomorrow we can rent out for anywhere between $900 to $1,000 per month. And if you look back on, we've talked to other big time in real estate investors, people who've had huge portfolios who rode out the 2008 storm, and the people who were investing based upon cash flow were fine. They actually didn't bat an eye. It's the people who, like I said before, were investing on appreciation. Because if you actually look at rents and what happens to rents in a down cycle, rents actually stay even or sometimes even rise. Because a lot of people are making a commitment to be a homeowner when they probably shouldn't. They're getting a little too outstretched financially.
Right.
They might be a business owner. They might have a good job. They just get overextended. And so, yes, foreclosures increase, but rental demand actually picks up. And also because it's uncertain times, people don't want to lock themselves into that type of financial commitment. So again, people who in a more stable market might be homeowners are a little more leery, and they're going to become a renter. So when we're investing on cash flow, we don't care, like I said, what the property prices go up or down. And even if we're buying at $40,000, let's say our values go down to $30,000, the house is still renting out for $900 to $1,000 per month. So I don't really care necessarily what the underlying asset, what my Zillow estimate says it's worth, or whatever the mark to market type of scenario.
Right. And we don't have a counterparty risk. And if there's a credit crunch or times get tough, we don't have to find another buyer. All we have to do is ensure that our rents equal the principal and interest and the utilities that are due for the property that month.
Good.
So we're able to weather out without a foreclosure.
So one thing that obviously needs to be addressed when you talk about real estate is location, location, location. I think, Zero Hedge made headlines when they said that folks could pick up a $500 house in Detroit, right? But there's a reason that it's so inexpensive. So, if someone's a novice at this and they're going to pursue this kind of investment strategy, what are the basics? What do they need to know before they're even thinking about their first purchase in terms of location or getting the right deal, making it so that it's really worth their while?
Read Rich Dad Poor Dad. And then I started as a private lender. I actually started as a private lender to Bob's. I would read Rich Dad Poor Dad. I would change your paradigm from an accumulation and an appreciation mindset to a cash flow. All that matters is that you bring in enough cash to meet your expenses that month. And then you survive month one, and then month two, you get a little better. You make a little more money, and eventually it starts compounding.
And it's really, the fundamentals of real estate are not that difficult to learn. It's as simple as, hey, we're bringing in, $1,000 per month in rent on the property. Our expenses between tax and insurance are going to be probably $200 per month, and our payment to our private lender or our payment to a bank, is going to be $400 per month. So we got $1,000 coming in and $600 going out, and that's the magic. There is just that spread. It's not a quick rich thing. You get quick rich, but you do that spread, that $400 per month spread, 10 times, 20 times, 50 times, 100 times. And it's repeatable, it's reliable, and it can provide passive income and ability to weather some of these financial storms that we all think are coming.
So speaking of financial storms, I think I included it in my book, Financial Judo. Last year, Sam Zell started divesting himself from many of his properties that he had purchased in 2007 or 2008 at a low. He's a billionaire for a reason. He's a smart real estate investor. What does that give you any cause for concern? Or are you still seeing great deals out there? What's your mindset at the moment in that regard?
Like, we're still buying. We always look at the tax records on the houses we buy, and we're still buying at half the tax appraisal from 2006, 7, and 8.
Yeah. So
like the next crash, it's like, how much farther can these houses go down?
And the other thing we haven't mentioned yet is, we did talk about cash flow as one of our priority metrics. The other big thing is, paper equity day one. So for that house that we're buying for $45,000 at 1,200 square foot ranch, there are sales in today's market in that neighborhood, same style house, same floor plan, everything at the $80,000 mark, $85,000 mark, $90,000 mark. So we're already buying properties at a discount, and that's the great thing about real estate is you can pick up good deals like that by going after distressed situations. We buy, I'd say probably 70-75% of what we're buying is foreclosures, short sales still. St. Louis, there are these type of deals out there every day. I don't know what the DC area is like.
The DC area is horrible because all the government money goes to those guys first, which inflates the asset prices out there.
Yeah, well, I'm not going to disagree with you.
You were talking about that last week on your podcast.
Yeah, I talk about it every week. DC is the parasite on the rest of the U.S. economy. They get to spend newly printed money that Janet Yellen runs from the Federal Reserve. And that's why, as I mentioned, a 1-bedroom, 400 square foot hut out in Middleburg, Virginia, which admittedly is an exclusive community and is on 2 acres of exclusive property, will still run you $365,000. So, yeah, the DC area is not a place you want to come if you're looking to buy an affordable home. Let me ask you this. How much money do you have to sink into these properties to make them inhabitable, or are you looking for properties that have been well taken care of?
We don't buy like stud rehabs. We buy stuff that just needs a little TLC.
Yeah. I'd say on average we're probably anywhere between $2,000 to $5,000 of repairs on these type of properties. And when I threw that $45,000 number out, that's like an all-in, including purchase and any money we're spending on the repairs.
Right.
And so I mentioned, hey, there's legitimate sales in today's market, at the $90,000 mark, and we're trying to be all in at 45. The other key metric we look at is replacement costs. Just based upon the materials if you were going to try and, if you had a bare piece of land right next door, what would it cost in today's dollars to build that same structure, right? Mm-hmm. And if you look at most construction metrics, for base level finishes, nothing too fancy. You're not talking, mid-range luxury, just basic builder grade. You're talking probably $110, $120 per square foot to build. So for that 1,200 square foot house, on the low end, we're talking $132,000 to build that house brand new today. And that's not even counting what you're going to be in the land. So if we can buy this structure that, is going to cost $132,000 with materials and labor in today's dollars, and we're buying it and being all in for $45,000, that's a lot of cushion in there that we know we're getting value day one.
So, as we discussed before the show, naturally, or you explained to me, this investing philosophy has a natural fit with folks who already believe in Austrian economics or maybe libertarian leaning. So, kind of flesh that out further. What do you mean?
Okay, so, and we're not talking real estate at this point. We're talking about investing in whole life insurance. If you put your cash, the money you're trying to store to save and not speculate with, and technically, it's your dry powder to invest, it's the only place in the economy where there's 100% reserve. It's the only place where there's no fractional reserve banking, and it's somewhat of a personal secession from the Federal Reserve banking system. So there'll never be on a run on a whole life insurance policy. If you go store $50,000 worth of capital in there, that life insurance company has to have that $50,000 on hand ready to give to you when you want it.
Well, very good. Well, you guys have given me a ton to chew on. As I said in the beginning, Jason Burak, he's a smart guy. I know you guys aren't dummies because our military academies don't put dummies through, and they certainly don't graduate dummies. So, I really commend you on what you're doing, and I hope you get absolutely filthy rich doing it. How do folks reach out to you?
I don't want to get rich. I want to create value and store that value inside assets.
Right. Well, as long as you're creating value, you are going to get rich. So that's an ancillary benefit, and I hope you welcome it.
I think part of the reason the middle class gets crushed is because there's no free market reason while middle class people should be investing in the stock market. Like, to take an Austrian idea,
right.
When Nixon took us off the gold standard, the stock market skyrocketed, and it was a bubble. And then you have all the full marketing machine of all the 3 networks that were existing in there, creating this image that this is where you go to get rich. And that's just not true. If your audience wants to read a book called The Pension Idea, it was written by a guy in the 30s when they started Social Security. And he's like, this is a fraud and it's going to lead to tyranny. And he's like, the way people store value and beat inflation is to invest in life insurance and real estate. And technically, that's what we're trying to do.
And that's where most people's portfolio was at 100 years ago. People didn't invest in the stock market.
Right. They would spend their whole life farming on a farm, and they would put their money in whole life insurance. And then when they wanted to retire, they would own or finance their farm to the next farmer. And technically that farm, that's a real estate investment.
Well, good. You've given me and the audience a lot to chew on. I really appreciate it. How can folks, follow up with you guys if they have more questions or want to continue to follow the progress of your organization?
Well, I would go to lauramurphy.com. I would go to Bob Murphy's website, because everything we learned from him. And, he's Tom Wood's buddy. And then if you want to visit us, you can email us at jointopsproperties@gmail.com or our website at jointopsproperties.com, and subscribe to our YouTube channel, because we put out a video every day talking about the glories of life insurance and real estate.
All right, folks, make sure to follow up with Jimmy and Bob at both those places. But Jimmy Vreeland and Bob Scott from Joint Ops Properties, thank you for coming on Kennedy Financial.
Thank you. Thanks for having us.